Okay, I'm recording this video on Thursday, July 29th, 2010, and finally, Emini-Watch.com reaches 500 posts. Emini-Watch was launched almost 4 years ago now, and we've been on quite a roller coaster ride. This is just a little chart of the S&P and the Emini, what's been happening. We started back 4 years ago at about 1400. We made it up to 1600, and then we had this huge collapse down to 666, and we've had a huge bounce back up to 1200. And here we are, kind of almost 4 years later, 500 posts, and it's the Emini is sitting at 1100 today. I thought it'd just be interesting just to kind of look back and see what's happened from an Emini-Watch kind of perspective over the last several years. The first thing is the global financial crisis. I mean, this has been center stage for so much of that time period. We really didn't know what was happening in the first half of the great move down, and then we've been wrestling with the aftermath of the financial crisis ever since. And really, when we say global financial crisis, it is an understatement. This is the worst recession since the Great Depression. And in my opinion, we could be at the beginning of a deleveraging depression, which will be history-making and game-changing, and not unlike what Japan's been going through for the last almost 20 years, with almost 0% growth and a just total mind shift in the way markets and economies work. The cult of equities could be dying. So much of the growth in the equities market since 1979 has been in additional leverage being added into the market. And if we go through a period where we're seeing deleveraging, then that's going to mean the equity returns are just not what they've been over the previous years. We've been relying on plus 10% growth in the equity markets, and that just might not happen over the next 10-15 years. And people, heroes like Warren Buffett that we've seen made fortunes on riding the backs of this kind of equity and leverage play, we could have very different heroes kind of going forward, people who do very, very different things. We could be moving back to an emphasis on the bond market and safe returns, and just paying a decent dividend rather than looking for capital growth and capital gain. And hopefully, in my opinion, we get back to basics, back to hard work, paying for performance, and less of this very glittery kind of period that we've had certainly during the 90s and the 2000s. And in terms of what's happened in the E-mini, I mean, we've had a revolution in the E-mini. The average volume has gone from 1 million contracts a day being traded to 2 million contracts a day. And the average range, back 3 or 4 years ago was 10 to 12 points. We're now seeing average ranges of 18 points, which is just phenomenal, which, just talks to the attractiveness of the E-mini market for day trading's perspective. There's loads of liquidity and there's loads of volatility and range to play with, which is a good thing from a day trading and a swing trading perspective. And my trading's evolved over that time period. When I started Emini-Watch, I had a very heavy focus on swing trading. I was probably about an 80% swing trader and only a 20% day trader, and that's totally flipped over the last 3 or 4 years. I now spend most of my time day trading and only 20% swing trading. Better volume, which was one of my key indicators, has gone through a couple of revisions and has actually now morphed into better pro-am. So something that I've received a lot of good response from from people in forums and people around the trading community. That important indicator from my perspective has morphed into a very important indicator, better pro-am, showing the average trade size and trying to identify professional and amateur activity and read what's going on. Also, the addition of better momentum, showing the strength of swings in buying and selling, has been an important indicator to be incorporated in my methodology. And then the incorporation of exhaustion volume, to look for that for trend changes. That's a prerequisite of a trend change. We need to see exhaustion volume as well as exhaustion price activity before we can see a change in trend. And then lastly, I've been getting better. I'm still not perfect, but I've been getting better at entering at trend changes a lot slower. Trend changes take a long time to develop, and there's no hurry to go enter a reversal trade. One of my key weaknesses has been entering way too early on reversals, and so I've been getting better at entering reversals more slowly. So what doesn't work, and this is just kind of personal opinion, what I've kind of learned over the last 3 or 4 years. The first one is seasonality. I really think that seasonality these days is little more than a 50-50 proposition. Yes, there are seasonal swings in the market. I mean, there are things, earnings releases, tax time, and so on, that have a big bearing on, the 12-month annual kind of seasonality of the market. And yes, we have, the presidential 4-year cycle, which has a big bearing on the way the market goes. But can you use seasonality to trade the market? I really find it difficult to believe that. And so in my own trading, I'm spending more emphasis on getting rid of ideas and getting rid of things to look at. And so seasonality is one of those things that I just now no longer look at, because it just clouds my judgment rather than adds to the decision-making process. The next thing is correlations. Because we've had, a game changer in terms of the global financial crisis, correlations that were working for almost decades, things that, the bond market and the equity market and how they work together, a lot of those correlations have broken down. And so, the lesson learned is correlations work great until they stop working, and the problem is you don't know when they're going to stop working. And so I spend less time looking at kind of correlated markets. A lot of the markets are moving in sync together, and so trading single markets and being very focused on a single market, I think, is a better plan than looking at more things and getting, again, kind of clouded judgments and saying, well, these correlations have to snap back at some point, we need to trade with that in mind. And part of the kind of correlations that I'm kind of wary of these days is commitment of traders. I spend a lot of time, talking about commitment traders over previous years. And if you've been watching Emini-Watch over the last 4 or 6 months, I've not spoken about commitment of traders very much. And for me, that was doing some extra research over the last few months, which was looking at this hedging and trend following activity by the professionals. And what happens is the professionals flip from being hedging activity to trend following activity. And in retrospect, you can see that happening. But by forecast, can you actually forecast where the hedging and trend following activity is going to take place? And so, can the commitment of traders really give you an edge in terms of forecasting what the market's going to be? I think you still can get an edge in terms of understanding what overbought and oversold is in terms of commitment of traders. But then the specific entry that you're going to make is going to be based on some more kind of fundamental, lower time frame technical analysis. So again, commitment of traders for me, it's still interesting things to look at. I still look at it every week, but I pay less attention to it in the decision making that I have in my trading these days. Next comes price patterns, and price patterns I still think have some value, but you have to get the trend direction right first. You'll see all kinds of price patterns, reversal price patterns happening counter trend. But it's only when the trend has changed that those price patterns really come into their own and give you good entry points. So using price patterns alone, I think, is a very kind of dangerous game, and I've kind of stepped away from that as well. Then using price alone, I mean, this is something I've felt strongly for many years. Why so many traders are ignoring volume in their analysis just baffles me. Literally, it is 2/3 of the data out there. You have price, you have the volume traded at the bid and the ask, and you have the average trade size. And that's what the better momentum, better sine wave, better pro-am indicators are based on. And for me, it seems just logical that you look at all the pieces of the puzzle out there. If you're just using price, I know it's very simple to create price-based oscillators, moving averages, Fibonacci numbers, all of those things. But you're ignoring 2/3 of the information, and it just needs a little bit more work on the analysis to develop kind of volume-based indicators. And then lastly, looking at multiple markets and getting confused. Focusing on one market is a real kind of key, and just being focused on the E-mini for me has been a real benefit. And then not looking at multiple time frames. I'm not sure why so many traders just focus on single time frame charts. They're either pulling up a 5-minute or a 15-minute chart, or an hourly or a daily chart, and so on. Really using multiple time frames, I think, has a huge amount of benefit. So that's, in my humble opinion, what really doesn't work for me, at least in terms of trading. So that begs the question, what does work? Well, the first thing is, although I think you're not able to focus in the long term, what's going to be happening in the next several weeks or months or even years out, I do think it is possible to forecast out minutes and hours ahead. And that's because you're just assuming that the momentum of the market will continue for the next few minutes or hours. And I think that's still a valid assumption, and you can trade based on that. So shorter time frames, you're going to have more success trading shorter time frames because you can assume momentum will continue and that you can actually forecast what's going to happen for the next few minutes and hours.